This is the story of how a country sitting on 303 billion barrels of oil, more than Saudi Arabia, more than any nation on Earth, came to represent less than 1% of global supply, and what it would actually take to change that. Venezuela holds 17 to 20% of the world's proven oil reserves. On paper, that makes it an energy superpower. In reality, decades of mismanagement have turned those reserves into stranded assets that barely register in global markets. Understanding why requires looking at the collapse of Venezuelan production and the enormous gap between what exists underground and what can actually be extracted. The numbers tell the real story here. Venezuela pumped 3.5 million barrels of oil per day throughout the 1970s, the 1980s, and the 1990s. It was one of the world's premier petroleum exporters, and American refineries along the Gulf Coast were specifically built to process that Venezuelan heavy crude. Today's production sits somewhere between 800,000 and 1.1 million barrels per day. That is a collapse of roughly 75% from that peak. Years of underinvestment and mismanagement left the state oil company PDVSA estimating it needs $58 billion just for basic rehabilitation. Industry analysts point out the pipelines have not been updated in 50 years. Current Venezuelan output represents less than 1% of global oil supply, which explains why political instability in Caracas does not move markets the way it once did. American exposure turns out to be even smaller than you would expect. Chevron operates as the only American company still working in Venezuela under a special treasury license, exporting approximately 120,000 to 150,000 barrels per day to the U.S. in the fourth quarter of 2025. For perspective, 1.3 million barrels per day flowed from Venezuela to American ports at the 2001 peak. During the strictest sanctions period, from 2019 to 2023, that number dropped to 0. Global oversupply further diminishes Venezuela's market relevance. Brent crude recently traded at $60.75 per barrel, with West Texas Intermediate at $57.32 per barrel. Neither price sits particularly high by recent historical standards. The International Energy Agency projects global supplies will exceed demand by 3.8 million barrels per day in 2026, a record oversupply that absorbs potential disruptions. Jorge Leon at Rystad Energy notes that even major geopolitical events struggle to move prices when there is this much oil in the market. Arne Lohman Rasmussen at Global Risk Management puts it bluntly, there is still too much oil in the market, and that is why prices will not go ballistic regardless of headlines out of Venezuela. American consumers see this reflected at the pump. The Energy Information Administration forecasts prices averaging around $3 per gallon in 2026, down from $3.10 in 2025. Energy analyst Doug Terrason projects gasoline prices 10 to 15% lower this year than last. Leon frames the consumer impact directly. Even a $2 to $3 per barrel increase in the price of oil would have a very, very marginal impact on U.S. consumers at the end of the day. One area does matter more than headline numbers suggest, and it involves what refineries call heavy crude substitution. Between 1990 and 2010, Gulf Coast refineries invested approximately $100 billion specifically to process Venezuelan and Mexican heavy crude. These facilities need 30 to 40% heavy crude to optimize their yields, which translates to 2.5 to 3 million barrels per day of heavy crude imports required industry-wide. Citgo stands out among the key facilities because it is a PDVSA subsidiary with more than 800,000 barrels per day of capacity across Illinois, Louisiana, and Texas. Valero Port Arthur handles 335,000 barrels per day, and Motiva processes 626,000 barrels per day as North America's largest refinery. Where do these refineries source heavy crude if Venezuela cannot supply it? Canada exports over 4 million barrels per day of bitumen that is virtually identical to Venezuelan crude. But pipeline constraints limit flexibility. Mexico's Maya crude provides 600,000 to 700,000 barrels per day to the United States. But availability keeps declining as Mexico increases its own domestic refining capacity. Colombia offers 200,000 to 300,000 barrels per day of the closest substitute for Venezuelan grades, but it has limited ability to scale up production. Reduced Venezuelan supply creates a 200,000 to 500,000 barrels per day backfill requirement that refiners manage, though not painlessly. Diesel, jet fuel, and asphalt production feel the squeeze more than gasoline. Rebuilding Venezuelan production would require staggering investment and time. 303 billion barrels of reserves could theoretically generate enormous wealth. The gap between theory and reality is where things get complicated. Francisco Monaldi at Rice University estimates returning Venezuela to 4 million barrels per day would require north of $100 billion in investment and at least a decade. Bob McNally at Rapidan Energy Group notes that while about 1/3 of current Venezuelan production faces various risks, this poses no meaningful threat to oil markets in the short term given production has already fallen so far. History offers sobering comparisons for post-crisis oil recoveries. Libya's production collapsed from 1.6 million barrels per day to under 300,000 barrels per day after Gaddafi fell in 2011, and 14 years later, it remains unstable. Iraq still produces only 75% of its 1979 peak levels. Iran pumps roughly 60% of what it produced during the Shah era in 1974. Leon warns directly that history shows political transitions rarely stabilize oil supply quickly, with Libya and Iraq offering clear and sobering precedents. Foreign investment in Venezuelan oil adds another layer of complexity. Over $60 billion in loans flowed from China to Venezuela, the largest Chinese lending to any single country, and more than $20 billion remains outstanding in oil-backed debt. Chinese state companies hold joint ventures in the Orinoco Belt, and in August 2025, China Concord Resources signed a 20-year, $1 billion production-sharing contract with Caracas. Russian investment totaled approximately $34 billion between 2001 and 2018, with Russian companies operating joint ventures producing roughly 100,000 barrels per day. November 2025 brought Venezuelan approval of a 15-year joint venture extension worth $616 million. The bottom line for American markets comes down to a simple disconnect. Venezuela possesses the world's largest oil reserves, but current production barely registers in global supply. Any meaningful recovery would require $100 billion investments over a decade or more, and historical precedents suggest rapid turnarounds rarely happen. Global oversupply absorbs potential disruptions, keeping gasoline prices stable for American consumers. 303 billion barrels remain in the ground. The infrastructure to extract them at scale does not exist anymore, and that gap between what Venezuela could produce and what it actually does explains why the world's largest oil reserves have become almost irrelevant to the markets that once depended on them.